Hello all, this is Akshay Menon, analyst at PMS Bazaar, and welcoming you all for today's webinar. Uh, Today we have Mr. Rushabh Sheth and Ms. Ekta Mehta for the topic Accessing Dynamic Strategies for Today's Market through Karma Capital, Magnolia PMS. Let me start off with a formal introduction of Mr. Rushabh Sheth, who's the CIO and co-founder of Karma Capital Advisors. His experience spans over 29 years with 21 years in money management, primarily in listed equities. At Karma Capital, he is also a portfolio manager besides contributing to the overall corporate management. Over the span of his career, Mr. Rushabh has been involved with various formats of money management, such as portfolio management, mutual funds, and offshore funds. He has closely been involved in the evolution of the fund management industry in India. In his engagement prior to Karma Capital, Mr. Rushabh worked with capacity of CIO Equities at Kotak Mutual Fund, a part of Kotak Bank Group, between 2003 to 2005. Under him, assets grew eightfold for the company during this period. Rushabh started his career with ASK Raymond James, now ASK Investment Managers, as an investment analyst in 1993. Later, he was involved in various leadership roles at ASK, including Director of Business Development and Portfolio Manager. He holds a bachelor degree in commerce from the University of Mumbai and qualified cost accountant from the Institute of Cost and Work Accounts of India. So moving on to the next person of the day, Ms. Ekta Mehta, who is the portfolio manager at Karma Capital. Ms. Ekta is a portfolio manager at Karma Capital Advisors. She has over 11 years of experience spread across multiple facets of investing and financial analysis. She is responsible for managing large cap funds along with coverage of companies in key sectors like banking, financials, insurance, FMCG, hotels, hospitals, and oil and gas. Prior to Karma Capital, Ekta was with MSCI and SGE and explored various domains of indexing and investor relations. Before that, she was with BNK Securities as a sell-side analyst covering the media sector and had a brief instinct of research associate at Karma Capital. Ekta completed her MBA in finance from NL Dalmia Institute of Management Studies and holds a CFA degree from ICFAI University. So over to you, sir. And before giving the podium to Mr. Rushabh, I request the audience or the panel to put their questions on the chat, on the Q&A box and not on the chat box. And it will be taken after the PPT. Thank you, sir, and over to you.
Thank you so much, Akshay, for that kind introduction. Thanks, PMS Bazaar, for giving us this opportunity to do this webinar. And thanks, everybody, for joining, taking time out and hearing what we have to say. So really appreciate this. I just wanted to quickly introduce the firm and what we are doing. And I will hand it over to Ekta once I finish to talk more about Magnolia. Karma is a boutique, long-only investment manager based in Mumbai. We have been in business since 2005. We got our license in 2006. So we have been now around for about 17 years. For the length of time that we have been around, not many people know us because we've always kind of loved being under the radar. Karma manages about 550 million US dollars, so about 4,500 crores of assets, mainly offshore institutional money. Norges Bank is our largest investor, which is Norway's sovereign wealth fund. We basically are owner-managed firm. So the firm is owned by the employees completely. It's been the case all throughout our existence. So from a perspective of managing the India dedicated money, for us, this is the only thing we do. We don't have any other business. Almost after 15 years of running a single strategy, we started adding a couple of strategies to our domestic for our domestic clients. Magnolia is one of them. For the frontline strategy, which is Karma Wealth Builder, that we have managed for about 16 years. Over the last 10 years, we have compounded money at about 19% against 15% for the benchmark. So we've done a recent job. We have been around for more time than most people have been. Most of our peers have been. From our perspective, we're now starting to Magnolia because we think that there is an opportunity for us to kind of add value in this space. I will leave Ekta to maybe talk more about it. Today, we are a 23 people team. Pramod, my colleague who is co-head of business development, is on the call. And so will be Rajnish, who is our CEO. And we are all there to take your questions at the end of the presentation once Ekta finishes. From our perspective, we started to build our domestic business. We have built our presence across now 4 key cities. And we think that we are now ready to expand the domestic market, and Magnolia is an effort in that direction. Ekta, not taking up too much of your time, I will leave you to kind of take it from here and talk more about Magnolia and about yourself. Thanks everybody for the patience. And once Ekta finishes, we'll be very happy to, all of us are here to take the questions. Thank you so much.
Thank you, Rushabh, for the kind introduction. Hello and good evening, everyone. Thank you, PMS Bazaar, for giving us this opportunity to speak today. So what I will do is I'll quickly run through the presentation so that we have some time to take questions in the end. So let me just share my screen. So I think today we are sitting at a market which is kind of at an all-time high. And I think everyone here would agree that, equity as an asset class has generated wealth for investors over the years, whether they have chosen an active route or a passive route. So I don't want to get into this whole debate of active versus passive. But what I do want to address is this whole noise around passive investing, because especially from a large cap perspective. So what we have seen, there is a report by SPIVA, which is S&P investments, S&P indices versus active funds, is that more than 80% of large cap equity funds have underperformed the benchmark index in the 1, 3, and a 5-year period as of December 22. So we try to dig deeper as to why this is the case, especially from a large cap perspective. And what we found is that most of these funds had a low active share. So active share is basically the percentage of the portfolio that deviates from index. So when we say a low active share, what we mean is that the larger chunk of the portfolio is kind of replicating the index. And when we look at the top 10 mutual funds by size, the largest mutual fund by size had an active share of about 44%. And within those top 10 mutual funds by size, the lowest active share was at around 31%, right? So what it means is that about 60 to 70% of the portfolio of these funds was kind of similar to what the benchmark index is, right? And there could be various reasons for having a low active share. It could be because you want to be less volatile, or because as the AUMs of these mutual funds keep growing, the size becomes a constraint and liquidity becomes an issue, right? Anyway, so the point being, the larger share of the portfolio being closer to the index, and you add back fees over it, then the probability that you will outperform the benchmark index becomes lower. And that is what we have kind of tried to address through our Karma Magnolia PMS. Karma Magnolia would be a concentrated portfolio of about 20-25 stocks. And of course, it would be on the core principles of Karma, which is growth at reasonable price and early cycle investing. What this will lead to is a portfolio which will have a high active share. So, how are we different compared to others? So, of course, we are purely bottom-up investors. Hence, we have no sectorial biases. And there's a lot of research that goes into our stock selections, which is why we are very picky in the kind of companies that enter our portfolio. And we will have no cash calls. We generally don't take aggressive cash calls. Of course, when a new client comes in, we will slowly deploy it over a period of 1 or 2 months. But as a rule, we are generally fully invested. But what do we mean when we say we are benchmark aware? Is that as the benchmark is about 78% focused towards large cap, we would also have a bias towards large cap in the terms that at least 70% of the Magnolia Fund would be invested towards large cap. And large cap is as defined by SEBI, the top 100 firms by free float market cap as large cap companies. So what do we expect out of Magnolia? So it will result in a portfolio of large quality businesses with a great future potential. And of course, we will have some exposure to small and mid caps. So what we are trying to endeavor out of this is have a portfolio which would be less volatile, but will still generate superior risk adjusted returns over 3 to 5 years. And here we are trying to address, clients who don't want the volatility, which is very inherent in a small and mid cap portfolio, but still want the upside or the alpha over the index, right? Which is where we think Magnolia is the ideal fit. Now, early cycle investing, what do we mean when we say early cycle? We are early cycle investors. So we believe that, like everything in life, businesses also go through cycles, right? And we have seen this time and time again, that prices generally bottom out much after businesses have bottomed out. And what we have seen is most of these companies don't have have come out of a past which is not very rosy, but are entering a very exciting growth phase. So at this point in time, when the businesses are kind of turned around, the narrative around this businesses is still kind of a reflection of their past. And which is why at this point in time, these companies are available at a very reasonable valuation. So, this chart kind of explains our whole philosophy of early cycle investing and growth at a reasonable price. And if I have to explain this through an example, then SBI is one of the prime examples. So if you go back in FY18, it was a time when SBI was going through a very tough phase, both in terms of business and in terms of asset quality. In fact, FY18 was a period when it had the highest level of NPAs and provisioning. So if you are so we were, as of December 19, what we saw was that it was most of this NPAs had already been recognized, and the incremental requirement for recognition was lower. And in fact, so the provisioning requirement also would be lower going forward. And SBI, with a size and scale, would be able to generate better returns, better profitability and return ratio, and which is kind of played out over the next 2-3 years, where in fact in FY23, it reported the highest ever profit of more than 50,000 crores. Right. So if I have to explain it through another example, so Bharti, if you go back in the year December 2020, the industry was coming out of a very difficult phase, where the entry of a new player had completely disrupted the market. And but at that point in time, Bharti had already taken one price hike, and the industry had consolidated very nicely from a 6-7 player to a 3-player market, and the top 2 being very dominant. So what we saw is that this, of course, being an industry with very high fixed cost business, the operating leverage going forward would play out, and with the increase in top line, which is kind of what has happened in the last 2-3 years, where, the operating margin from 40% has improved to 50% plus. So this is what we say when we say we are, kind of early cycle investors. And all of this is at the basis of a lot of rigorous and deep research that we do in-house. So this kind of process is very sacrosanct. Of course, it has evolved over the years as we have grown, but it's very critical to us because, at the end of the day, you can't control the outcome. The process is what you can control, right? So if you take the listed universe of about 5,000 odd names and do the basic screening of, let's say, liquidity, minimum size, ESG, you would have about 500 names, which would be kind of acceptable. And then you further break it down in terms of management capability, quantitative factors, sustainable growth. You would have about 300 names. These 300 odd names is what is under active coverage within the research team at Karma. And we believe in a lot of kick the tires approach, do a lot of groundwork, and we do a lot of research in-house. We have our own models, right? Of course, we have some help from the sell-side analysts, but we go and meet the competitors. We do a lot of channel checks to understand how the industry is panning out. So basically, this 340 names, we break it down further to 100 based on our research. And of course, out of these 25 odd names which enter our portfolio. So like I was saying, about 340 odd companies that we track very actively among the 8 people research team that we have. And this is kind of a breakdown of those companies in terms of sectors and market cap, because India provides that opportunity in terms of depth and breadth. So I know this slide is a little busy, but what we have tried to do is we have tried to cram in our entire process into one slide. And like I was mentioning earlier, this is very important, critical to us, because many a times since we are early cycle investors, we are kind of, we have to develop an independent view because it might not be in consensus with the general street view at that point in time. And which is why, the investment team meets every alternate days to discuss these ideas. And of course, we give feedback, which then they go back, circle back, collect more data, get clarifications from management. So what it does is basically it leads to cross-pollination of ideas within the team, as one person who's covering a different sector would have a certain perspective on a company which is covered by someone else. So yeah, for key sectors, we have a primary analyst and one backup analyst. But at the end of the day, the portfolio manager and the analyst has to agree before a stock is entered in the portfolio. What we look for is we look at the size of the opportunity. We look at the growth potential and the scalability of the business. Does the industry have very high entry barrier? But what is also important is the rate of change, rather than an absolute number in terms of capital efficiency. So we look for companies, where the starting point not be that great, but whether the company is eventually reaching the desired capital efficiency numbers that we are looking for. So, and all of this together culminates into a very high conviction portfolio of stocks using the early cycle and growth at reasonable price philosophy that we follow at Karma. So yeah, like I was mentioning earlier, for us, rate of change is very important, because, while past is important, future is also very important. So when we look at companies, we look at the future potential rather than the past, right? So, there are two things which define the valuations of a company. Of course, it's the underlying fundamentals or the earnings of the business, and also the multiple that is ascribed to these businesses. And generally what we have seen is that as the business is coming out of those downturns, the valuation that is ascribed is lower because of the recency bias. But as the fundamentals start improving and you see the earnings catching up, you will see the valuation ascribed will also start improve. And that is why we feel that is where you will generate the alpha in companies. So yeah, that is why we say the rate of change is more important over absolute number. So yeah, apart from research that we do, portfolio construction is also a key factor for us. So generally we start our position small as 1.5%, and we slowly build up our positions in the portfolio. Like I mentioned, it's a concentrated portfolio of 2025 names. And generally we are very top heavy. So top 10 would constitute 55 to 60% in our portfolio. And also we look at companies from a longer term perspective. So an average holding period for our companies would be 3 to 5 years. And hence we would have low turnover, and which is why the operational expenses would also be lower. And so eventually it will lead to a portfolio which has a high active share and low volatility. In terms of selling strategy, the key one being that, our thesis have played out and the valuations have reached at a level which we find are no longer attractive, or we find that it's not reasonable anymore. Or it could be that we have found a better opportunity, which we feel will give us better returns compared to the companies that are already in the portfolio. These are the two big reasons why we will look to sell a company from our portfolio. But apart from that, of course, if there are any negative surprises in terms of, corporate governance issue or a misrepresentation of facts or fraudulent activity, even then we will take a call in terms of the companies that we have in the portfolio. Why Karma Capital? I think most of it is already covered by Rushabh in his initial remarks. But what I do want to stress on is that we have a portfolio of very high conviction stocks, and that conviction is built in-house rather than borrowed because of the kind of in-house research that we do and the kind of process that we follow. And of course, we are patient and a long-term investors. We look at, like I mentioned earlier, we have an average holding period of 3 to 5 years. And that is why, the ability to think independently and have a contrarian view is very important for us. In terms of risk parameters that we follow, like I was saying earlier, since we are top heavy and a concentrated portfolio of about 20-25 names, there could be some concentration risk. And of course, because we are early cycles, many a times it's kind of contrarian or not in consensus with what the market view is. So it could lead to some near-term volatility. So yeah, this is a brief on me. So I have more than 12 years of experience, of which more than 9 years I've spent at Karma, looking at various sectors like BFSI, FMCG, hotels, hospitality, retail, etc. Yeah, this like Akshara mentioned, Rushabh and Nikhil started the firm in 2005. They have more than 29 years of experience in the industry. Rajneesh, of course, joined us last year. He has more than 28 years of experience. He joined us from Invesco. So yeah, this is the research team. As you can see, most of them have more than 10, 11 years of experience in the industry. And of course, the varied experience that they have. This is kind of the brief snapshot of the portfolio. From the right side, you can see that healthcare is a big part of our portfolio. You know, it's more than 20% compared to an index, which is at around 4-5%. So that kind of shows the kind of differential portfolio that we have. And the table below is the snapshot of our companies. You can see the incremental growth that we have, that we expect in the earnings of these companies, and of course the valuations, which are at much reasonable level. Yeah, so let me just say that the marketing team's details are available at the bottom. So if you have any questions related to the fund, you can always get in touch with them. Yeah, so I'll just stop here, and I'm happy to take questions now.
Thank you, ma'am. Thank you for that very brief, knowledge you gave about Magnolia PMS, which is newly launched. Thank you for that. So before, I have a set of questions to be asked, and of course, I could see questions pouring on the Q&A session as well. So before I could take audience questions, so I just wanted to take one question from my end, is that in this industry, in this finance or fund management industry, women fund managers are actually, the percentage is very less, and that's why they call it as a male-dominated industry. In such industries, you have made your own niche in that. So I just wanted to know, like, what were your past experience and what are the funds that you were handling in past and their performance? If you could give a gist on it.
So yeah, so like I mentioned earlier, I've been with Karma for more than 9 years. In fact, I started my career at Karma, then went around, tried different things, and now I've joined back Karma about 7-8 years back. What I've done is I've tracked a lot of sectors, be it FMCG, banking, BFSI, IT, hospitality. I'm sorry, what was the second question?
How the funds that you've managed in previous
so Karma Magnolia is a newly launched fund, so we have just launched it. So yeah, it's a newly launched fund. Yeah.
Thank you, ma'am. So with that, let's start with the macros part. First, the thing, all of us know that Nifty and Sensex is trading at its all-time high. It's almost reached 65 and 19,000 respectively. So how do you see the equities moving for next 3 to 4 months or next quarter? How do you see the movement of the equities?
So you are right. In the last 3-4 months, we have seen a very sharp rally in the markets. But, we have to look at it from a long-term perspective. You will have near-term volatility, and there will always be noises, whether it is inflation or interest rate or geopolitical risk. Today these are the noises that you will hear. Tomorrow there will be something else. But if you look at it from a long-term perspective, of course, India has a lot of growth potential going forward, and we should see improvement. Of course, index, even after the run, is still trading at its 10-year average valuations of about 20 times. So yeah, so we've still not reached that unreasonable levels, but from a longer-term perspective, we remain bullish.
So how do you expect the earnings to grow in 2023? Like, we're already done with first quarter of it. So we have got 3 more quarters to go. So how do you think the earnings will move?
Last quarter, Q4, so Q1 numbers are still to come out for most of these companies. But Q4, what we have seen that earnings were kind of mixed, where, we have seen good numbers from autos and pharma, but, kind of sluggishness in IT companies' results. What we see is that, at an industry level, most of these companies have kind of deleveraged, so debt levels of these corporates are currently at an all-time low, and we should expect these companies, and of course the growth potential is very high, so we should expect strong earnings from companies this year.
Okay, and Magnolia is the name, it's named after a flower.
Yeah.
And why was that? Is there any uniqueness that this PMS carries that it is named after a flower? Or it was just a random thing?
Okay, so no, it's not a random thing, it is a well thought out strategy. We wanted to keep some so Magnolia has a peculiarity. It's a all-weather flower and continues to spread fragrance wherever possible. All through the year. So behind naming Magnolia is to also certainly pass that message. It's an all-weather strategy. It will not work that if you see even the construction of the portfolio, if you see there's a decent exposure to large cap and mid cap. And then we tried our this strategy to be closer to the benchmark as compared to our existing flagship, which is a complete benchmark agnostic strategy. So idea is to generate a decent alpha over the cycles, be closer to the benchmark, not showing a lot of volatility. So that was the idea, and that's how the pitching of the product also is like that, to offer a product wherein somebody who's been investing into PMS mutual funds for the last 5-7 years has a decent small and mid cap exposure, want to migrate to PMS. That's wherein this fund comes in, wherein we intend to offer a decent return, lesser alpha, decent return at a lesser volatility vis-a-vis a lot of our peers, maybe, but slightly more volatile, or maybe in line with what a lot of small and mid-cap mutual funds for that matter.
Okay.
So, that was the idea. So constructing an all-weather portfolio which continues to spread fragrance or alpha over a period of time, that was the idea behind this.
Thank you, Pramod, for that answering that question. Thank you. So let's move on to the next question, ma'am. So while mentioning in your PPT, you were mentioning about the graph, which is like growth at reasonable price for a strategy that you use for selecting the stocks. Of course, if you want to highlight a bit more with an example, so that it's easy for us to understand how the stock picking is done. So if you could take an example with that.
Sure. So I try to explain that with an example in the PPT. So, the most recent example, if I have to deviate from the presentation and give you another example, and the most recent one, I think, would be the airline sector. Last 2-3 years, because of the COVID and rupee depreciation and the crude prices, we had seen the airlines reporting we saw airlines reporting a lot of losses in their P&L. But what we in the Karma saw that the travel was picking up, and the growth for travel was picking up, and the industry had consolidated quite a bit, with top 2 players having more than 85% market share, right? So if I have to explain it here, so at this point in time, so a few months back, at that point in time, the valuations of these companies were available at a very reasonable level. Of course, the growth potential was very strong at that point in time. And which is why we, kind of looked at one of the aviation stocks at that point in time.
Okay. Thank you, ma'am. And of course, when Pramod was explaining about it, I know it said he had mentioned about decent alpha generation. So market can be volatile. It can come up or can go down. It's unpredictable, and it's very difficult time in the market. That's very. So how do you sit on cash calls? Because when you give a promise of saying a decent alpha, so how much do Karma Capital sit on cash?
Like I mentioned, we don't take aggressive cash calls. Of course, when there is a new client which comes in, we are very careful in deploying cash. So we would take about a month or 2 to deploy the entire. But once it's deployed, we don't generally take aggressive cash calls. At most of the times, we are completely fully invested.
Okay. Magnolia PMS. Magnolia PMS as like 70% of the funds are into large cap.
Right.
Only 30% has been shifted between small and mid caps.
Correct.
But do you find any traction now for small mid cap funds? Do you think the market is quite biased on small and mid cap funds because they are growing in huge number? Is it?
In fact, on the contrary, after the sharp run up in the small and mid cap stocks over the last few months, I feel the valuations have become a little stretched. And I would say large cap offer a much better risk reward compared to a small and mid cap right now. But Rushabh, sir, you want to add something here?
Yeah, I think what is needed is more a stock picking and a bottom-up thought process around it. I don't think so. We are too focused on the wider markets and valuation. For us, we are running concentrated portfolios. So it's basically we need to find, say, maybe 5 or 10 or 15 or 20 stocks which are available at a reasonable price. And I don't think so that's very difficult. So for our perspective, it's more finding the right ideas at the right price. We are not too worried on the markets. We think that at any given point of time, if we work hard enough and if we kind of look hard enough, we can find a few of these ideas from our perspective. So we are more focused bottom-up investors rather than worrying too much about the top-down market. And of course, as Ekta mentioned, markets have gone up. So there is a little bit of a push up in the valuations. But I think finding ideas at a decent price which we think have a good long-term future is not such a difficult thing.
Okay. Thank you for that. Over to you, ma'am. But okay, we have an existing portfolio. Is there anything recently that you've added weightage on? Because of course, when you in your PPT, you just mentioned that you're sector biased. You're not sector biased. So is there any other sector that you're overweight or underweight on, which is recently you have changed your allocation on sector wise?
So currently, we are overweight on healthcare and auto ancillaries. But we are always on the lookout for, like Rushabh sir mentioned, we are bottom investors. So we are always on the lookout for new ideas, which, we feel have growth potential. So currently, we feel, logistics, aviation, auto components, healthcare could have a lot of companies that we are actively tracking.
Okay. In one of your recent interviews, when I saw you were very bullish upon Karma Capital as such. Were very bullish on pharma and telecom sector. Because when a person is largely invested in large cap, they go for financial. They go more bullish on financials. But rather, there's a change. There was a bit change for you went for pharma and telecom. Is there any reason? Do you find any? Why was that bias towards pharma and telecom?
So, what we have seen is that pharma has come out of a phase, where the capital deployment was a big issue over the last few years. And now it has reached a phase where, the companies have kind of been very efficient in their capital allocation. And also we have seen that, the price erosion that was happening in US in double digits has now come down to single digits. So what we see going forward is a lot of growth potential in these pharma companies. And of course, the valuations that they are available at is much reasonable level. And which is why we prefer, currently we are so overweight on healthcare.
Okay. And about telecom, because
yeah, so again, so industry has kind of, there are industries which have kind of grown from consolidation to fragmentation, and then there are industries which have gone from fragmentation to consolidation, and telecom is like the prime example. I've kind of explained the whole thesis around Bharti in my presentation. So what we have seen is that, over the past few years, the industry has kind of consolidated among 3 players, and the top 2 being the dominant share, having more than 60-70% of market share. And like I mentioned earlier, this is a very high fixed cost business with a lot of operating leverage. So, as we see growth going forward, we should see the fundamentals kind of trickling down to the profitability. And of course, the data consumption and the usage of, I don't have to even get into that because we can see that on ground, the kind of growth, exponential growth that we have seen in data consumption and use of telephone.
Okay, ma'am. Is there any sectors that Karma Capital might not invest? Is there any sectors that you have kept that you might not invest on?
We generally stay away from global cyclicals. We kind of not great at spotting those in terms of where the commodities are driven by global dynamics. So we stayed away from that. And by and large, otherwise, we are very open to looking at ideas across sectors. We're not really, that's really the strength, and that's really where we see an opportunity that we can go and look at ideas in the same breath, say in healthcare or in logistics or in retail or FMCG. So Apart from global commodity-based businesses, I would say that we are open to looking at ideas across sectors.
Okay. Thank you, sir. If you could elaborate on the AUM, which is managed by Karma Capital, and the performance, like how consistent was Karma Capital as a whole? If you could elaborate on it.
So, as we mentioned, we are more offshore centric. Of our 4,500 odd crores of AUM, I would say 90% plus is offshore institutional money right now. We are now starting to build our domestic. We think that there is a huge opportunity in the domestic space as well. From offshore institution perspective, Norges Bank, which is Norway's sovereign wealth fund, is our largest investor. They have been with us for now more than a decade. So that kind of gives you a color on the kind of investors we have. As I mentioned, Karma Wealth Builder, which is our flagship, has delivered 19% compounded returns for the last 10 years, which is a decade, against a 15% for the benchmark. So that kind of gives you a little bit of a color in terms of how we have done. We have a very long track record over the last 16 years for this kind of thing. And now we are hoping to build a similar one for Magnolia, which you kind of called Ekta about. And I hope I've answered your question.
Yeah, you did, sir. Thank you for that. And Karma Capital is not only with Magnolia PMS, it has a wealth builder as well as flagship PMSs. So how does this Magnolia PMS differ from the other PMSs that Karma Capital possess?
Yeah, so let me just start and I'll hand it over to Ekta. So what we have done is to recollect, we've been managing money for the 16 odd years, and we've had a single strategy all throughout. Now as a team, we are now at a point where we are getting more ideas. And we think that, as Pramod mentioned in his remarks, that we need a strategy which caters to a set of audience or clients who are more looking at a large cap buyers with maybe lower volatility, because our existing strategy is completely benchmark agnostic and has a slightly higher skew of small and mid cap. We were looking to add a strategy which is maybe kind of a little bit of an opposite to that. Of course, Ekta can maybe give you more color on Magnolia, but that's the reason why we think that there's a large opportunity to create alpha even in large cap. Unlike a lot of people, we believe that there is an opportunity. If you are not a benchmark hugging, if you have a high active share in large cap, there is a large opportunity in this space as well. Maybe Ekta, you want to add to that, or Pramod, if you want to add to that.
Yeah, sure. So, the flagship is kind of benchmark agnostic, and we are kind of benchmark aware. So flagship product, which is KWB, is not biased towards any capitalization, whereas we would have minimum 70% towards large cap, which is what even the benchmark kind of has 78% towards the large cap. And how we differ is we would have only about at maximum of 30% towards small and mid cap, right? So clients who don't want the volatility that is inherent in a PMS, which is, very small and mid cap heavy, but still want to have a superior returns, is where, Magnolia differs from KWB. So less volatility, superior risk adjusted return is what we are looking at.
Yeah. Thank you, ma'am. But of course, when he mentioned that Karma Capital is 16-year-old, it's one of the pioneers in the industry. So you would have seen a lot of clients and the HNI movement in this industry. So how do you feel the sentiment? Because earlier the HNI's sentiment was completely different from today's. Because today's people are taking a bit more risk compared to the other, previous HNI generation. So what difference do Karma Capital as an AMC feel when they deal with the HNI clients?
So yeah, let me start off, and maybe Pramod can add more if he wants to. So generally what we have seen is that, yes, clients have become more aware. And also because they have become more smart over the years, they have realized, and of course, equity as an asset class has become a more acceptable investment proposition compared to the past. And we have seen that, clients are getting more aware, have more products available to them to do their own research, where PMS Bazaar also, of course, helps them out.
Okay. Thank you. Thank you for that. And we got to see SEBI is giving a lot of rules and regulations. These days, SEBI is being quite strict on making the fund look perfect. So what is your view or AMC's view on such regulations coming up?
So let me just start, and maybe Rushabh sir, if you want to add something, you can add. So yes, there have been certain changes in the regulations, but what we try to do is focus on our business and look for investment ideas and look for to be within those guardrails that the regulator comes out with, and try to outperform the benchmark, because we are very focused on our investment process.
Okay. Anyone wants to add it?
I think Ekta is right. I think our focus is more to really look at where we can add value to our investors, how we can generate returns on a risk-adjusted basis. Of course, the regulator will do its bit, and we have to be in line with whatever the regulatory guidelines are. And over the 16, 17 years, we've seen a lot of evolution in the regulatory process, and we have adjusted to that. So I don't think so we are too worried about it. We think that it's a part and parcel of life, and you kind of live with it.
Okay. Thank you, sir. Thank you for answering the questions. Thank you for that. And moving on to the next question that I have was that when you say you are keen into early investing into large cap, so it's basically like maybe the index has not given such percentage of what Karma Capital Magnolia PMS has given. Is that what you meant?
No. So when we say we are early cycle investors, what we are trying to do is we are trying to recognize companies whose past might not look very rosy, but they're entering that growth phase, and hence the valuations are cheap and reasonable, but still there is growth potential going forward. So when we say we are early cycle, what we mean is that, the general narrative or the consensus view about that company is still on the recent past performance of these companies. But what we look at is the future potential rather than the past outcomes of these companies. And that is why we say we are early cycle, because we try to recognize these companies where there is a rate of change happening, where, while the starting point might not be where we want it to be, but eventually the company should reach to that level. And that is where we think we will be able to generate alpha.
Basically, it's like you consider stock or sector which can be not attractive today, but probably in future it can look attractive. So such kind of stocks or sectors, Magnolia PMS would inculcate in their portfolio. Is that to just about what you said? Is that
Yeah, let me just add here. Look, what we mean is that the economy changes colors. Okay, when the economy was going from $1,000 per capita to $2,300, $2,400, which we are today, a different set of businesses did well. As we go from 2,200, 300, wherever we are, to say $5,000 per capita, a different set of businesses will do well. So from our perspective, what we are trying to say is that flocking the same horse might not work. Looking back and saying that, look, this company did very well for the last 10 years and therefore will continue to do well for the next 10 years, that might not work for an investor. What the investor needs to see is where the next future growth is going to come from. In a country like India, where it's a domestically driven economy, we are not going to be anywhere close to China in terms of manufacturing, even in the next 5 to 10 years. We are going to be a domestically driven economy. The consumer spends, the consumer preferences will change dramatically as we go from $2,200 or $2,300 to $5,000 per capita in the next 7 to 10 years. And for us as investors, this is very critical that we look at the future, not the past when we look at investing. And that is going to remain, it's going to become even more critical because the rate of change, as Ekta mentioned, in many industries is accelerating. So the cycles are becoming shorter. The technology disruption is becoming more. And as investors, you need to be aware of where this is going, what industries or businesses will do well. And I think that is what we mean by early cycle. It's not just about companies that were not doing well, but it's also about companies that will do well in the future. And as investors, the past is important, but the future is far more important. You are not investing for the past. We are not investing for the past glory. We are investing because we think this company will do well in the next 3, 5, 10 years, not because the company has done well in the last 10 years. So I think investing with the past is look like driving a car with a rear view mirror. Yes, the past might be great, but that doesn't ensure or that doesn't mean that the future will be great. And we have seen so many changes. If you look at the index composition over the last 30, 40 years, you look at what were the businesses which were part of the index, which is the top index components, and that's so different. Even if you look at 5 years and 10 years, forget 20 and 30, the top 5 or 10 or 20 companies would have looked very different. So as investors, we are buying the future, not the past. And that is what we mean by saying early cycle. I'm sorry, it's a long answer to your question, but I kind of wanted to clear the air in terms of how we are looking at it.
Yeah, it was a very brief one. It was very brief one. Now, with the question, I've got another question to ask. Like, when you say that when you compare India and China and all, so people are very bullish on India growing to 5 trillion economy. I think it's a very common, statement that every fund manager gives, because people take a pinch of salt with it, because every fund manager are bullish are bullish on India, because as an asset class. India, they feel it is very soon is going to become a $5 trillion economy. So your views on it, sir, or anyone who wants to take that question.
Yeah, so my view is very simple. It's not a question of if India will become a 5 trillion. It's just a question of when India will become a 5 trillion. The other question is what will do well from that 3.6 or 3.7 trillion that we are today to 5 trillion. That I think is more important and pertinent question to answer from an investor standpoint, rather than trying to take a guessing game to when India will become a competitor. I think the process might be far more interesting, and the journey might be far more interesting. Eventually, we will get to 5 trillion. Whether we get in 2029 or 2030 or 2031, I don't know. But more important is what will do well. What are the businesses that will do well? Where you will think a lot of value will be created as an investor. And that is, to me, is far more important and far more valuable. So that is the question. So I don't think so we are in the guessing game of when it will become a 5 trillion. I think it will become. It is a question of time. I mean, it's just mathematics. You put it on an Excel sheet and you can figure out depending on what growth rate you take. I think the more interesting and important thing is what will do well. What is the more interesting thing which will create value for us as an investor from now to then?
Okay. So I in between your voice were quite breaking, so I couldn't completely follow it. But yeah, I got the gist of what you were so actually. And move on to my next. It's just that Magnolia PMS, the very newly launched, it got launched around the month of Feb, if I'm not wrong. So if you want to talk about its monthly outperformance, it has not outperformed its benchmark. So what were the challenges that Magnolia PMS had to face? Because it's very new strategy for the audience.
Yeah, see, this was posed in one of the questions also, that would you construct it upfront? See, one of the differences and why would you come in a PMS and how is a PMS better than mutual fund? The investors largely need to understand that PMSs are largely a bespoke strategy. They are constructed to large extent on what you need. Unlike mutual fund, which is like a pool strategy, wherein irrespective when you come at current point in time, all the investors hold similar portfolios. PMSs don't work like that. Okay, they are constructed individually, and I have answered to one of the queries here. When you give us money, we buy stocks individually for you in your name. Okay, it is not it's not bought in the name of a pool. It is bought in your name, and we buy essentially. We'll never buy something we are selling for somebody else in our portfolios. Okay. Yeah. So the portfolios are constructed individually and they're built slowly. Okay, because in our case, after all our due diligence and everything, what is there in our hand at the end of the day is the price we are going to pay for the stock. Okay, so it may be so that I'm selling something wherein I've held in for 5 years and the stock has reached multiples wherein we are not comfortable. I won't buy it for that, but it may be 3%, 4% in my overall portfolio. But I won't even buy 1% for a new investor as of now. I'll rather buy something else. So I need cash. So cash is developed. It's invested very, very slowly. So like you said just now, the portfolio is just a couple of months old. The investors who have come in initially and who are coming in now, there is a substantial part of cash which is reflecting as an overall in the composite. And that is what is actually dragging down the performance. If you look at equity to equity, no, we've actually been delivering performance over the benchmark for sure. But then there is substantial amount of cash which is slowly getting reduced. And as more investors are coming in, more cash is also coming in.
Yeah. Okay. Thank you. Thank you. That was a good answer. Thank you. Thank you for that. And to moving on to the next question that I have was that we spoke about the sales strategy that Karma Capital has. So how often does the churn in the portfolio happen? Like how often you buy, how often you sell? No, the sell and buy and sell happens in Magnolia PMS portfolio.
Magnolia is pretty new, so of course we are just building up the portfolio. So of course we don't have any sales for now, but what I can talk about is generally we buy from a 3 to 5 year perspective. So generally we would have a very low churn. In fact, in our flagship product we have, the average holding period is about more than 5 years. So it kind of reflects the kind of long-term investing that we do.
So Magnolia PMS, like from an investor perspective, so how long you expect the investor to stay with you for the PMS? Like how long you want a investor who is going to invest in Magnolia to stay along with you?
Yeah, so minimum that we look at, in whether it is Magnolia or any other fund, equity fund, we would always advise our clients to have a 3 to 5 year time horizon when you're looking at equities.
Okay. And even Magnolia is a large cap PMS. We have a lot of competitors for large cap PMS this year. So how do you feel Magnolia is different from other large cap PMSs in the investment industry?
Yeah, so I try to capture all of that in the presentation. So we don't have like a long tail of 50 odd stocks. It is a concentrated portfolio of 20-25 stocks, which is built on very high in-house conviction that we have done because of the extensive research that we do. And because of the whole philosophy that, kind of repeating the same thing again and again, the growth at reasonable price and early cycle investing, we kind of, have a list of 20-25 names which have kind of very different from, where the benchmark is, which is what I was trying to explain in my presentation. Like you see from the sector allocation of Magnolia, healthcare and auto components is a big part, is some of the top 3 sectors, which is what you will not find in other large cap funds.
Okay. So if you were to compare this fund with mutual fund large cap, because as Pramod just spoke about that, if you were to, because when you talk about alpha generation, people will, compare mutual fund and, PMS. So if you were to answer that question, if a client who's ready to invest in that 50, large cap mutual fund, and if you want to, convince that one investor to put that in Magnolia. So what will be your conventional point on that?
Again, going back to the first slide, where, you will see that, these large cap mutual funds would have a lot of, so of course, first would be the basic, the client's requirement in terms of their risk appetite and financial goals. But, when you look at mutual funds, they have this 40-50 names in their portfolio. And we, on the other hand, would have concentrated bets in our portfolio. And of course, we don't have the regulatory constraints in terms that if we go beyond 10% in one stock, which is very high conviction for us, we'll have to sell it off. It doesn't apply to us. And of course, this PMS portfolio would be very individual. We don't have a model portfolio approach. So each client's portfolio will be generating depending on the kind of prices that are available at that point in time. So it's not that, when a client enters a mutual fund, they'll get a NAV of that period and, the cash is deployed. Whereas we, of course, go slow, maybe take a month or so to deploy the entire cash that we have. So, of course, that's a lot of differences between a mutual fund and PMS.
Yeah, I also want to add something. My sense is very simple here. Look, there are 2-3 things why we will be different. One is, I think the future will be different from the past. I think one thing you have to be very clear as an investor is that and also the gravity asserts itself. As you get bigger, the gravity, will ensure that you get closer and closer to the ground. Otherwise, it's not going to work for you. So very simple physics will work on the larger, as the funds become larger. This is something which we are going to see. And therefore, what Ekta mentioned right at the beginning is the index hugging nature. Because as you grow larger, you don't have a choice but to get closer and closer to the index. So from our perspective, there are 2-3 things. One is we think that we are smaller, we are nimbler, we'll be much faster to move. Second, we think that the future will be very different from the past. So the businesses that are going to do well in the future will be very different. And it's important that we spot the businesses of the future rather than the past. what will happen with larger mutual funds is that they will be more backward looking because they will have to get closer and closer to the index. And my sense is that a lot of the economy which will do well is as we go from $2,400 to 5,000 will be very different from one which we did well, whereas the index will reflect that, which is where today the financials are. So this is my 2 bits to it. Pramod, please go ahead and you can add whatever you.
Okay, thanks, Rushabh. So see, one thing which investors, at least the audience currently need to understand, and I'm not going to share something very different. This is all evidence, all this data is available in the public market. And on the contrary, what is happening is that people, and this is what Ekta also said initially, there's a lot of narrative being built around passive investing without even looking a level below that data. And somebody, I think I always request investor to do at least some scratchy research on what they're going to invest in, why somebody saying something and why is it so. See, we did this exercise, and in fact, one of our peers also did this exercise. The top 10 largest large cap funds in the market. Okay. The range of active share is 45% to 32%. So largest large cap fund in the market is 45% active share. To make it simple for anyone to understand, it is 55% in the index. Okay. Now here the fund itself is investing 55% of its corpus as a index fund. Okay, then 45% is slightly out of it. How do you expect that fund to actually beat the benchmark when you have a decent amount of expense you're supposed to deduct out of it, and this is all regulated? I'm not blaming the fund house. I'm not blaming the fund manager. It is the environment they work with. So they have already been given a regulatory environment. They're constrained on what all stocks they can pick. That's one. Second is that they're also constrained in the terms of the charges they can build in, wherein again PMSs have an edge. So PMSs have an edge, the kind of stock, the average allocation to a stock, the maximum allocation to a stock, the as far as even the customization of the cost is concerned, PMSs have an edge over there. And then of course PMSs are not bounded, and even from their investor mindset, we believe that somebody who has an ability to cut a 50 lakh rupees check is somebody who's been in the market for a fairly long amount of time, as compared to somebody who's managing a large scale mutual fund. Quite possible that he'd be investing money for a first time investor. It is his, even as a fiduciary responsibility, the fund manager's obligation to ensure that he doesn't offer a lot of volatility to his investor. So it is completely two different worlds we are talking about. As a PMS player, we believe somebody who's cutting a 50 lakh check is somebody who's been in the market for good 5-7 years investing into equities, and he understands how volatility is. He would have seen ups and downs, and he would know that I'll have to probably the downsides or the drawdowns are the point wherein he has to put in more money in the market to actually make the best out of it, which isn't the case from the investor set of a large cap mutual fund. So not blaming anyone, but actually giving you a proper color that if there is an underperformance in a lot of large cap funds, because it is only because they are structured like that. It's not that the active funds cannot generate returns. There are active funds generating returns. There are essentially, even the large cap space, they say 88% funds are actually not beating the benchmark. I'm saying there are 12% which are beating the benchmark. Or you look at ETF, there is no ETF, there is no passive index fund, there is no ETF which is beating the benchmark. What would you choose? A 12% chance to actually beat the benchmark, or a 0% chance to beat the benchmark?
12%. Option A, anyone would choose.
Yeah, thanks.
Yeah, thank you for that. Actually, with that, we have come to the end of the session. So thank you. Of course, I must thank Mr. Pramod, because he was answering the question, just following on the Q&A box. He made my work actually easier. So I had all the privilege to take my questions on that today. And thank you, Mr. Pramod, for doing that. And I would also like to thank Ms. Ekta and Mr. Rushabh for giving us a very good understanding on this Magnolia PMS is completely newly launched by Karma Capital. And of course, as the name suggests, it is meant for the fragrance. Let the fragrance groom even brighter. And that's a wish from PMS Bazaar side as well. Thank you, ma'am.
Thank you. Thank you. Thank you so much.